Hey everyone, and welcome. Today we're going to pull back the curtain on something we all use pretty much every single day, but maybe don't really think about: the financial system. We're going to break down how money actually travels from people who save it to people who need it, and how that whole process fuels, well, pretty much everything. Okay, let's get into it. Seriously, have you ever stopped to think about that? You put a little money away in the bank, right? And somehow that helps someone open a brand new coffee shop or a tech startup or maybe a pizza place down the street. It seems like two totally separate things, but believe it or not, that connection is the very heart of how our economy works and grows. And that right there is the big idea. At its core, the financial system is basically a giant, incredibly complex plumbing system designed to do just one main thing: get money from point A to point B efficiently. It's the engine that takes idle cash and puts it to work. So, to really get this, we've got to understand the two main groups of people, or units, in this whole story. See, the entire system exists to solve one fundamental problem: a mismatch between folks who have extra money and folks who need more of it. First up, you've got what economists call surplus spending units, or SSUs for short. Now, that's just a fancy way of saying savers. If you make more money in a month than you spend, congratulations, you're an SSU. And most of the time, this group is made up of regular households, just like you and me. On the flip side, you have the deficit spending units, or DSUs. And you can probably guess. These are the borrowers. Think of a business that needs a loan for a new factory, or the government needing to fund a new bridge. Their spending is way more than their income, so they've got to find that money somewhere. And connecting the SSUs with the DSUs, well, that's the name of the game. Okay, so how do we actually make that connection? How does the money get from the savers to the spenders? Well, it turns out there are two main highways that this money can travel down. And this is so important to understand. You've got direct financing, where a company, say, sells a bond straight to an investor. Simple. The investors claim their IOU is directly on that company. But then there's indirect financing, and this is where a middleman, like a bank, steps in. You deposit your money in the bank, and the bank turns around and loans it out. Here's the key: your claim is on the bank, not on whoever ultimately borrowed your money. This is a perfect example of how it works in the real world. You've got Bob, a student with $5,000 he wants to save for a year or so. Then you've got Tony, who needs $25,000 for a 5-year loan to buy a new pizza oven. Their needs are completely different, right? The bank acts like a transformer. It takes Bob's small, short-term deposit, pools it with others, and turns it into the exact large, long-term loan that Tony needs. That transformation process is what we call financial intermediation. So, where does all this financial activity actually happen? It's not just one big room somewhere. The financial system is really a collection of different markets, and each one has its own specific job. Let's break down the different venues where this all goes down. This distinction is absolutely crucial. The primary market is where new stuff is created. Think of an IPO, an initial public offering. When a company sells stock for the very first time to raise money, that's a primary market transaction. The cash goes straight to the company. But from that moment on, every time those shares get bought and sold between investors on, say, the New York Stock Exchange, that's the secondary market. The company sees none of that money. It's just investors trading amongst themselves. I absolutely love this analogy. It just makes perfect sense. The secondary market gives investors liquidity. That is, the confidence that they can sell their used stock whenever they want to get cash. Without a healthy used car market, a lot fewer people would buy brand new cars, right? Well, it's the exact same idea here. A strong secondary market encourages people to invest in the primary market. We can also slice up the markets based on time. You have money markets, which are all about the short-term sprint. We're talking less than a year. This is for managing day-to-day cash needs. It's generally pretty low risk. On the other hand, you have capital markets. They're for the marathon. This is where companies and governments get long-term financing by selling things like stocks and bonds. Okay, so this brings us back to a really important question. If direct financing exists, why do we even need these middlemen like banks? Why don't all the savers and borrowers just find each other directly? And the answer really boils down to two words: market friction. I mean, in a perfect world, maybe they would. But in reality, it's really hard. You have transaction costs, the time and money spent just making a deal happen, and even more critical, you have information costs. How do you know if a borrower is trustworthy? Intermediaries exist to slash both of these costs. And the biggest information problem has a name: asymmetric information. It's actually a pretty simple idea. The person borrowing money always knows more about their own financial situation and their willingness to pay it back than the person lending the money does. It's just like buying a used car. The seller knows every little thing that's wrong with it, but you don't. And that information gap, well, that's where the risk comes in. This leads to our first major headache, called adverse selection. This happens before any money changes hands. Imagine you're a lender and you can't tell the good borrowers from the bad ones. You might have to charge a high interest rate to everyone just to be safe. But guess what? That high rate scares off all the safe borrowers, leaving you with a pool of the absolute riskiest people, the ones who are most desperate for the loan in the first place. Then there's this second problem, moral hazard, which happens after the loan is made. So a business gets a loan by promising to use it for a super safe, boring project. But once they have your cash, they might get tempted. They might think, hey, let's use this money for a really risky venture instead. Why? Because if it pays off, they keep the profits. But if it fails, well, it's the lender who loses most of the money. It's a problem of hidden action. And this is why intermediaries are so incredibly valuable. Banks are experts at this stuff. They have whole teams that do nothing but screen borrowers to weed out the bad risks. That's how they fight adverse selection. And they write really detailed contracts and monitor borrowers to make sure the money is used the way it was supposed to be. And that's how they fight moral hazard. They are, at their core, specialists in information. So the whole system is built to move money around while managing all these tricky information problems. But just because it's designed to handle all that doesn't mean it's risk-free. Oh, not even close. And that's where a whole layer of oversight comes in. I mean, look at this. These institutions are constantly juggling a ton of different risks. You've got the most obvious one, credit risk, the risk that someone just doesn't pay you back. But there's also interest rate risk. What happens if rates suddenly spike and the value of your bonds plummets? There's liquidity risk, not having enough cash if everyone wants their money back at once. And then you have the global stuff like foreign exchange and political risk. It is an unbelievable balancing act. And here's the so what. Because if one of these major institutions fails, it can create a domino effect, a cascade that could take down the entire economy. That's why this industry is one of the most heavily regulated in the entire world. The rules are there to make sure banks can handle losses and manage their risks, all to keep that economic engine running. And that really leaves us with a final thought to chew on. This whole massive global system is built on two things, trust and information. But today, technology makes transactions happen in a fraction of a second, and markets are connected in ways we couldn't have imagined. As it all gets faster and more complex, the big question is, how do we make sure that the stability and trust that it's all built on can actually keep up? Something to think about. Thanks for joining me.